Okay,
Well, Ed,
so
thank you very much for doing the interview today. And we want to talk, first of all, about the Norwegian Sovereign Wealth Fund and its decision to divest itself of small to medium sized oil and gas producers. Can you give us a little background on why they're doing that?
well, the decision's being made by the manager of the sovereign wealth fund, the Norwegian bank, and it's a full exit from independent oil and gas producers. It's not an exit from the integrated oil and gas producers, the majors, the Shells, the BPs. It's a it's a it's a dropping out of this area of the independents, and they're doing this for portfolio diversification reasons. Number one, this space has not returned the cash, the returns that other industrial sectors have. So, for example, the S&P 500 over the last 10 years has returned more than 200% to a purchaser of the S&P 500, whereas independent oil and gas producers in the United States have only returned about 24, 25%. At any given period over the last 3 months, 6 months, a year, 3 years, 5 years, 10 years, oil and gas independents have not generated rates of return that have been competitive with any industry. Consumer durables, medical products, tech, um, beverages. It just hasn't given the rates of return to a portfolio manager that other industries have. Now, why
Well,
do
Ed,
people?
let me jump in for a minute. Is that also true of the U.S. shale basins and in particular the Permian Basin?
Yes, it is.
Now, why is it that the independents in the Permian, which is supposedly the most prolific basin in the world, why aren't they making money in the Permian?
Well, it's a very high cost play. And so a lot of Wall Street have bought into the fact or the promise that with continued production, cost will go down. The challenge has been, when they went out into the shale plays at $80 and $100 a barrel, which was not too long ago, that could work. But in the Permian, producers need between 45 and $50 a barrel on average at the wellhead in order to be profitable. And we can see this by the accumulation of ducks that continues to rise in the Permian, also across the rest of the United States. We have over 8,000 ducks, drilled but uncompleted wells. And this indicates that these cost savings are perhaps exaggerated.
So, what is going to happen to those independent producers? Are they going to be snapped up, their assets bought by some of the bigger and more successful shale producers?
Well, my research shows that many of the shale plays are trading at values less than the cost of replacing those assets. In other words, the market value might be $100, but to go out and to replace those assets, one would have to pay $150 on the ground. And so what we're going to see is a lot of consolidation as companies that have cash have the ability to merge into public entities and make acquisitions with very cheap stock.
One of the things that's happening in Alberta, in particular, is that the big oil sands companies, the integrated companies that have refineries down in the U.S. or have refineries in Canada, are doing quite well. The junior producers, the mid caps that don't have take or pay contracts on pipelines, don't have their own refineries, are selling at spot prices, are really bleeding a lot of red ink. Now, is this part of a cyclical thing that we're seeing, or really is this a structural change in the industry, and you expect to see a lot of consolidation so that the big companies become bigger, and we see fewer and fewer independents?
Well, at a time when folks aren't able to cover their costs, you'd expect to see them getting the heck out of the business. And so the integrateds in Canada, such as Suncor, just the same as Chevron in the United States. This is a fully integrated company. It's a major. It has the ability to make money at the wellhead. And if that's not an option, it can make money downstream because it has low cost feedstock to pump through its refineries, to pump through its petrochemical plants. And so we're seeing a move towards uh, uh, refinery expansions in the US and across the world as the industry vertically integrates. Saudi Arabia has been building refineries in Saudi Arabia and across the globe in order to integrate, to pick up the value add that happens at each step in the chain.
So it sounds like this is a global trend. It sounds like exactly what's happening in Alberta with the bigger producers, and we should expect only more of it. Now, one of the charges that's laid in Alberta is that the policy is inducing these kinds of changes, that it's emissions compliance costs or it's other kinds of environmental policy. But it sounds to me, from what you're saying, that this is really driven by the fundamental economics of the industry.
Yes, it's just the fundamental economics. And Alberta is suffering because it doesn't have enough takeaway capacity. And that's because we don't have enough pipes to the US or pipes to the Pacific. Canada produces much more oil than Canada consumes. And so it's a challenge. If Canada suddenly could grow oranges, maybe they'd grow more oranges than they can consume. They wouldn't be able to buy them from Texas and Florida. They'd begin competing with Texas and Florida. And so they would have to find a way to get the oranges to market. They would not achieve as much at the orchards, if you will, or the groves, as the reseller today does. So if an orange comes up from Florida to Alberta today, it may be as much as a buck a pound. But if you start producing them in Alberta, transportation is going to be a lot less, and it's going to be easier to bring them to market.
Well, Ed, thank you very much for this. Really appreciate it. And we'll look forward to getting back to interviewing you on a regular basis.
Thank you, Markham. It's a pleasure.